Welcome, aspirants. If you're prepping for any banking exam, you absolutely have to get your head around the RBI's new rules on capital market exposure. Look, they've taken decades of old circulars and boiled them all down into one brand new master document. And trust me, it's a real game changer. So in this explainer, we're going to break down exactly what you need to know to nail this topic. All right, let's dive right in. So here's how we're going to tackle this. We'll follow the RBI structure, nice and logical. We'll kick things off with the why and the what of these new directions. Then we'll get into the hard numbers, the stuff you absolutely have to memorize. After that, we'll walk through the general rules of the game, zoom in on different types of borrowers, and wrap it all up with a quick revision to make sure everything sticks. Sound good? All right, let's start with the basics. First, why did the RBI even issue these new directions? And second, what are the key terms you absolutely must know? Get these fundamentals down, and I promise the rest will be a whole lot easier. So why does the RBI care so much about this? Well, it all boils down to one word: risk. Think about it. Lending money for stock market activities, that's way more unpredictable than, say, a home loan, right? The RBI's main job is to protect the whole banking system from that kind of volatility. And that's exactly why they've rolled out these new directions, to finally consolidate dozens of scattered, old rules into one single, clear, up-to-date playbook. Okay, first key term you've got to lock in: CME. That stands for capital market exposure. This is the big one, the master term for everything. Think of it as an umbrella that covers all of a bank's links to the capital markets. This includes the bank's own investments, we call that direct exposure, and the loans it gives to you and me or to companies for market activities. That's the indirect part. And what's super important to remember is that both of these get counted. Next up, CMIs. That's capital market intermediaries. These are basically the machinery of the market, you know? Your stockbrokers, your custodians, clearing corporations, the whole shebang. Now listen up, because this is a potential exam trap. Under these new rules, mutual funds and AIFs are not considered CMIs. I'll say it again, they are excluded. You can bet that's going to pop up as a tricky question, so definitely highlight that in your notes. And the last key term for this section is LTV, which stands for loan to value. This is a really important risk management tool. All it is a ratio that tells you how much a bank is willing to lend against the value of your shares or bonds. So if the LTV is 60%, it means for every 100 rupees worth of securities you put up, you can get a loan of up to 60 rupees. See? A lower LTV means you have to put more of your own skin in the game, which gives the bank a nice big safety cushion. All right, pencils ready, because we're moving on to the numbers. And let me tell you, this section is probably the most crucial one for your exam. We're talking about the hard limits, the absolute ceilings that the RBI has set. You can be sure these figures will show up in your multiple choice questions. And here it is, the big one, the master limit, a bank's total capital market exposure. Remember, that's direct plus indirect, cannot, under any circumstances, go above 40% of its Tier 1 capital. Just think of Tier 1 capital as the bank's core strength, its main shock absorber. So what this rule is really saying is that a bank can't bet more than 40% of its core capital in the stock market. It's like the ultimate financial firewall. But wait, there's more. Within that 40% total limit, there's an even tighter sublimit. A bank's direct exposure, and that's the really risky stuff, like the bank's own money being put into shares or financing takeovers, that part is capped at just 20% of its Tier 1 capital. The RBI is basically saying, okay, the total risk is 40%, but the highest risk stuff, we're putting a much shorter leash on that. So how are you going to remember this in a high-pressure exam hall? Easy. Just think of it as the RBI's 40-20 rule. That's your mnemonic. 40% for the total, 20% for the direct. It's that simple. The 40-20 rule. Lock it in. Okay, now, knowing what's included in the limit is one thing, but knowing what's excluded is just as important. The RBI has carved out some specific exceptions that don't count towards that 40-20 ceiling. Things like a bank's investment in its own subsidiaries or in crucial financial infrastructure like NSDL or CDSL. You really need to pay attention to this list, because which of these is not counted in the CME ceiling? Well, that's a classic exam question right there. All right, so we've got the key terms down and we've got the big numbers memorized. Now let's talk about the general principles. These are the fundamental rules of the road that the RBI has set for any bank that's lending to the capital market. Now this slide is super important. It's basically the don't list. These are activities that banks are absolutely positively forbidden from doing. For instance, a bank can't give you a loan against its own shares. That's a huge conflict of interest.
And another big one, they can't lend money to a company so it can buy back its own shares. This is a list of strict no-nos, so definitely commit this one to memory.
Okay, so far we've been talking about the big picture rules, but these regulations aren't one size fits all. They actually change depending on who is borrowing the money. So now let's zoom in and look at the specific limits for individual investors, and then we'll see how they're different for the big players, the CMIs. In this table here, it's a perfect example of the RBI's risk-based approach. Just look at the pattern. If you want a loan against individual stocks, which can be pretty volatile, right? The LTV is only 60%. But if you're using a super safe AAA rated bond as collateral, the bank can lend you up to 85%. The logic is crystal clear. The riskier the asset you're pledging, the lower the LTV, meaning the more of your own cash you have to bring to the table. Okay, for individuals, there are two more numbers you need to remember. These are hard caps on the loan amount itself. The overall limit an individual can borrow is 1 crore rupees. But, and this is a big but, if the specific purpose of that loan is to buy shares, like in an IPO or from the stock market, then the limit gets much smaller, dropping down to just 25 lakh rupees. So 1 crore overall, but only 25 lakh for actually buying shares. Got it? Now, when we're talking about lending to the big guys, the CMIs, like stockbrokers, the RBI uses a slightly different term. Instead of LTV, they talk about haircuts. Don't let the name scare you. It's a pretty simple idea. A haircut is just the percentage that a bank discounts from the value of the collateral. So a 40% haircut on shares means that for every 100 rupees of shares, the bank only counts it as 60 rupees of collateral. It's really just the flip side of LTV, another way of building in that all-important safety margin. All right, let's switch gears and talk about lending to other corporates. We're going to dive into a really important, though slightly complex topic called acquisition finance. This is basically when a bank lends money to a company to help it buy another company. Now, funding a corporate takeover can be a risky business, so the RBI has put some very clear and strict guardrails in place. And for your exam, there's another great mnemonic here. Just remember the numbers 70-30 and 3-1. The funding split is 70-30. The bank can finance up to 70%, but the promoter has to put in at least 30% from their own pocket. And after the deal is done, the debt-to-equity ratio can't be more than 3-1. 70-30 and 3-1. Those are your magic numbers for acquisition finance. Phew, okay, we have covered a lot of ground. So it's time to pull everything together for a final comprehensive revision. This is where we'll go over the absolute key takeaways one last time so you have them right at your fingertips for exam day. Let's do a quick recap. First up, let's lock in those key definitions. CME is the bank's total risk in the capital markets. CII is your stockbroker type, but remember, it excludes mutual funds and IAFs. LTV is simply the loan amount versus the security's value, and acquisition finance is just funding to buy another company. Simple enough, right? Next, the key facts and figures. Remember the 40-20 rule. 40% total CMA ceiling, 20% direct sublimit. For individuals, the max loan is 1 crore rupees, but only 25 lakh rupees if it's for buying shares. For listed shares, the LTV is 60%. And for acquisition finance, it's the 70-30 funding split and a max debt-to-equity ratio of 3-1. These are prime targets for MCQs, for sure. And finally, let's recap the key rules and conditions. Remember what's prohibited. No loans for share buybacks or against partly paid shares. It's mandatory for banks to monitor the end use of the funds. For CMIs, there are specific collateral rules for guarantees. And for acquisition finance, the borrower has to be a listed profit-making company. These are the rules that hold the whole framework together. And that's our deep dive into the RBI's new rules on capital market exposure. So as you finish your revision, here's a final thought to ponder. By rationalizing all these rules, is the RBI paving the way for banks to get more involved in the capital markets? Or is it really about building stricter, higher guardrails for a potentially volatile future? It's an interesting question to think about. Thank you so much for watching, and all the very best for your exams.